Okay, so we are looking at the financial statement of a sole trader. We will look at that of partners or partnership business. We'll look at that of limited liability. Then we'll look at that of NGOs, or let's say non-profit. Right. So this is the first one. After that, we'll look at that of the others. All right. So sole proprietor, which we mostly refer to as one-man business, it's a business which is owned and run by basically one person. The final account of trading sole proprietorship businesses includes the trading account, the profits or loss account, and what? The balance sheet. These are the financial statements of the sole proprietorship business. Now, the trading account is prepared to ascertain the gross profit or the gross loss. And this is done by matching the revenue derived from trading. So if we are into trading, our revenue will be coming from what? Our sales. So we'll be matching our sales against our direct cost of trading. That's to do with cost of sales. All right, so that will be our cost of sales. Basically, cost of sales has to do with all the costs we incur in acquiring and purchasing the product that we sell. And matching your cost of sales against your revenue, or what I would say is revenue minus your cost of sales, gives you your what? Your gross profit or your gross loss. Then we now move to the profit or loss section. So this is prepared by ascertaining the net profit or loss from trading. And this is arrived at by deducting the total expense from the revenue. The net profit is when the revenue exceeds total expenses and vice versa. So net loss is when your total expenses exceeds your total what? Total revenue. The difference between your profit, your net profit, and your gross profit is that with your gross profit, we deduct the cost of trading, which is our cost of sales, from our revenue. Right. With regards to the profit, the net profit, we are deducting all expenses, including cost of sales, from our revenue before we arrive at our net profit or our net loss. Let me give you a format. Okay. So yes. Now, even from our normal commerce that we've done, the profit, the formula for determining profit is what? Is revenue minus cost. And that gives us what? Profit, or let me say losses, right? Or loss. That same format is what we use in preparing our profit or loss statement. Just that our revenue may be made up of two things. So main revenue, okay, then other revenue. So one, then two, other revenue. So main revenue has to do with, yeah, main revenue. So if we are into trading, then our main revenue will be coming from what? It will be coming from sales. Other revenue might be, let's say we have invested in another company and we are receiving dividend. Okay. Maybe we have some building, we've given it out, we are receiving rent income. We can be receiving interest from the bank. Basically, any income that we are receiving which is not in connection with our main business activity will be classified as what? As other revenue. Now, when it comes to cost, so cost is also the same. So cost also the same. So we have one main cost, which is known as cost of sales. Then we have other cost or expenses. So let's say other expenses, which we refer to as operating expense. Also operating. So cost of sales has to do with the main cost we have to incur before we can even make a sale, right? So if we are into trading, what is going to be our main cost? Our main cost will be the cost of acquiring the product that we sell. In fact, if you don't have any product, you are not doing any business, right? So our main cost will have to do with the cost of the product that we buy, the cost of transporting the product from the supplier's place to our workplace or our warehouse. All those expenses incurred in acquiring and transporting the product will be classified as what? As our cost of sale. Now, after the product has been delivered to us, probably in our warehouse, in our office, there are other expenses that we have to incur as part of business operations. If we cannot do the business alone, so we've hired people, we have to pay them their salaries. We have to incur electricity bill, water bill. In fact, the warehouse, probably we are renting it, so we have to pay rent. All these expenses are classified as what? Operating expense. So the moment the product is delivered to us, any other expense we incur are mostly related to what? Our operating activities. So our main revenue, which is going to be our sales, less our main expense, which is going to be our cost of sales, will give us our gross profit or our what? Gross loss. So this is what we mean by what? Gross profit or gross loss. Then our gross profit or our gross loss plus our other income or other revenue minus other expenses, that gives us our net profit or our what? Our net loss. So let's do gross profit or gross loss plus other income minus, let's say, operating. So that's operating expense. That gives us our net profit or our net loss. Net profit or our net loss. Any question? Any question? George, do you have any question?
No, sir.
Okay. Jifa, do you have any question?
No, sir.
Okay, that's fine. So if we are to arrange what we've done here nicely, and also for us to show details about transaction that has transpired, So this is how it will look like. So we will have our sales. So let's say our sales. Then we have our cost of sales. Cost of sales. Now we want to show the things under cost of sales. We said cost of sales has to do with all the expenses we incur, which is directly linked to what? The acquisition and or transportation of the product that we sell. Now, what happens is that before we make any sale or before we go out there to buy from our supplier, most likely we may have some goods with us. So at the beginning of today, we had some goods with us, and that goods is called what? Opening inventory. Inventory. So the cost of an inventory. Then after we are done selling whatever we have in our shop, that is where we go ahead to do what? To purchase from our supplier. So what we had plus what we purchased. And then if we incurred any transportation cost, right? So transportation cost. So let's say carriage inwards. Okay. Then let's say they were returned. Probably when we brought the goods, right? We realized that when we were arranging them in our warehouse or in our showroom, we realized that some of the goods didn't meet the standard that we required. So we had to return those goods. So if the goods has been returned, then it means we have to deduct the cost. Probably it was part of what we purchased and now we've returned it. So we have to deduct it. So we do that, then whatever we have becomes the cost of the goods we have purchased, right? Now, most likely at the end of the day or at the end of the period, we might not be able to sell all these products. Okay. So what we are going to do is we are going to deduct our closing inventory, the goods that are left, so that we can be able to determine the cost of the goods that has been sold. So we do that, then we get what? Our cost of sales. So our cost of sales. Let me just write the total balance here. So this is the cost of sales, meaning the cost of the goods that we have sold to generate this sales revenue. This inventory, the closing inventory, has not been sold yet. So it means it did not generate revenue. So if we want to know the cost of the goods or the cost we have incurred to generate this revenue, then we have to deduct what? The closing inventory from it. So revenue minus what? Cost of sales gives us gross profit or gross loss. So gross profit or loss. Now, mind you, this sales revenue, there are also instances where our customers would also return some of the goods to us. They would also be like, oh, I bought these goods and I was expecting to be of this standard, this quality, but it was not up to my expectation. So take your goods. So it means indirectly the sales were not made. So if the customer returns the goods, we have to reduce the sales value by the value of the goods that has been returned by the customer. Any question? Any question?
No, sir.
Okay. All right. So let's proceed. Okay. So we have our gross profit. Gross profit. Let's say gross profit. Then our other income. So we said our other income can be made up of what? Rent income, rent income, dividend. Oh, sorry. Commissions. Maybe we sold something for someone and we pay some commissions. Interest. So interesting. In fact, discount received. If you receive discount, it's an income. Discount received. So any other income that you are getting, which is not from your main business activity, it forms part of what? Your other income. So you add your other income to your gross profit, right? Then we now bring in our what? Our operating expenses. So operating expenses, we are looking at all other expenses we are incurring. So we can talk about salaries, we can talk about utilities. So let's just complete them. Can even talk about rent. In fact, discount allowed. So if you grant discount to your customers, it's an expense to you. You have to incur that expense. You have to bear that expenses. What are that expense? Insurance. All other expenses. All other expenses, basically. So you add them, then you come and deduct. This is an expense, so you come and deduct it from this your income. Then you get your what? Your net profit or your net loss. Okay. Any question? Any question? Any question? Does it mean we've understood everything?
Hello,
Any,
sir.
yeah.
I just joined, so I think
Yeah.
I'm missing.
Yeah, you just joined, so you're owing me like 3 cows. What again? Cows and then the copacha on name training then.
Snap.
And then snap, eh? Snap.
Club. No, club. They send me from
Snap.
the show.
No,
Snap.
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 Snap. Yeah.
Kwabra, you go pay.
Yeah, you should give
No,
me
no.
3 cows. 3 cows, 3 snaps. What? 5 white fowls. Then
Yes.
say, any brother game anymore.
Uh-huh.
Okay, so we were looking at uh, the financial statement of a sole trader. Okay,
Okay.
so we started with the profit or loss statement. So we said that the profit or loss statement is just like uh, your normal profit formula that you learned in your commerce. Revenue minus cost gives you what? Profit or your loss. So if revenue is more, it gives you profit. If cost is more, it gives you what? Losses. Now, what we do here is that we break your revenue into two. Your revenue, you have the main revenue. So main revenue coming from your main business activities. And we said this is like a trading organization. So their main revenue be coming from what? Sales. And then there is a possibility that they will be getting other income or other revenue. Example, if they have invested in other businesses, they may be receiving what? Dividend. If they have any investment with the bank, they may be receiving what? Interest. If they have a building or an apartment that they've given it out, they may be receiving what? Rent. So these are income, but it's not actually in line with what their main business activity. When it comes to the expenses, you also have two expenses, which is the main one and the other expense. So the main one has to do with the actual cost we have to incur in acquiring, let me see, which is also directly linked to our main business activity. So if we are into trading, our main business activity, our main business expense will be the acquisition of what we sell. So if we sell laptops, our main expense will have to do with the cost of the laptops. You get it. Now, this main expense is not limited to the amounts that we pay to the suppliers, but any other expense we incur in bringing the laptop to our workplace or our warehouse or our showroom. So depending on what you sell, if it's a car, then your showroom, right? Then after the product has been delivered to us, there are other expenses that we have to incur. And that's mostly called our operating expense. So probably are not doing it alone. You have some few workers, you have to pay them salaries. You have to pay electricity, water bill, insurance, and all this stuff. You get, so that there's it. So we decided to just arrange it. So our main revenue, which is sales, minus our main expenses, which is cost of sales, gives us our gross profit or our gross loss. And our gross profit or gross loss plus other income, which is the second one, less other expenses or operating expense, gives us our net profit or net loss. So arranging this and expanding it further, we have our sales. This is the sales amount. Then our main expenses, which is our cost of sales. Now we said what we do is that before you go and buy or purchase what you sell from your suppliers, you first have to sell what you have, right? If you have products, I doubt you would go and buy more unless you have sold what you have. So our first item here will be our opening inventory, the goods we had at the beginning of the period. Then if we are done selling, we have to purchase more from our suppliers. Okay. Then plus carriage in also the cost of transporting the product from the supplier's place to our workplace. It includes loading boys and all those things. So that would be carriage inwards. Now there is a possibility that the goods that we purchased here, right, some of them didn't meet our standards or the quality that we expect. So we had to return some of the goods. We have purchased the thing. So if we return, it means we have to deduct from what our total purchases. If we return, most likely the person, the supplier will give us our money back. So we have to deduct our purchases amount that we have recognized. Then at the end of the period, it is possible that we may have not sold everything, right? So we want to deduct the cost of the inventory left so that we will be able to determine the cost of the goods that has been sold to generate this sales revenue. Do you get it? Because the goods has not been sold, it's probably part of what we purchased. Let's say we had like 2 laptops, right? Then we sold them, so we had to buy extra 10. Now the extra 10, we had to return 1. So it means if we deduct this 1, it means indirectly we purchased 9, right? At the end of the period, we realize that we have 3 left. So we have to deduct this 3 from this 9 so that we can be able to tell how much the cost involved or the cost you have incurred to generate this sales revenue. If you deduct this 3 from this 7, this 9, it will give you around like 6, right? So 6 plus this 2, giving us what? 8. So it means we have sold 8 laptops, and that 8 laptops is giving us this total revenue that we have. Any question? Any question? Pabna, any question?
So I'm okay.
Okay. So this is our gross profit or our gross loss. Now we have to factor in our other income. So if we are receiving other income, maybe rent income, dividend, commission, interest on investment, or maybe we've received discounts from our suppliers, we add all this income to our gross profit or our gross loss. Then we deduct all operating expenses, so salaries, utilities, if we are also renting, if we also give discount to our customers, insurance. There are a lot of expenses, all other expenses that we are incurring, repairs, maintenance, all those stuff will form part of what our operating expense. And we deduct our operating expense from this our total figure here. And that gives us what? Our total profit, net profit, or our total what? Net losses. Any question? Any question? Any question? Okay, so if there are no questions, we will just proceed. Who remembers the accounting equation? We've done this. Who remembers the accounting equation? I think we did this last week. Accounting equation. Oh, you guys don't remember.
Yes, I think capital is equal to assets plus liabilities.
Assets plus liabilities. Is this George or Pabna?
George.
Who gave me the answer? Is it George or Pabna?
It's George. George.
Okay. Pabna, do you agree with him?
No, sir.
Okay. What's your opinion?
Asset is equal to liability plus capital.
Asset is equal to liabilities plus capital. Okay. So, George, this is the accounting equation. Asset is equal to liabilities plus capital or capital plus liabilities. Capital can also be equal to what? Asset less liability. This is the original equation. So if you want to do change of subject, this is positive, liability is positive. So if it moves and it crosses the equal to sign, it becomes what? Negative. So your the only issue with your equation is that this should have been minus, not plus. Do you get it?
Yes, that's true.
Okay.
Very true.
So with assets, liabilities, capital, we will also expand them. Now you realize that there are some assets that we can use more than one financial year, right? The benefit we can get from that asset would exceed one financial year. Or let me say, will exceed the next financial year. Some of the assets, the benefit that we can get, we can fully consume the benefit within the next financial year. So we are in 2025. By the end of 2026, we would consume all the benefits associated with that asset. And those assets are called what? Are called current assets. Then we have others that the benefit that we would get from those assets would exceed 2026. We are in 2025 now, but the benefit that we will get will exceed 2026. In fact, we will get 2026, we will get 2027, we will get 2028, we will get 2029. You can even get 2030, right? Those are called non-current assets. So if the benefit is going to be consumed within the next financial year, it is current. If it's going to exceed the next financial year, it is what? Non-current. When you come to liabilities, realize that liabilities, it can also be current liability. So what it means is that whoever gave you the facility, if it's a loan, expect you to pay the entire amount within the end of what? 2026, or let's say by the end of 2026. So by the end of the next financial year, this liability should have been what? Sorted out. So we sometimes refer to as what? Short-term liabilities. Short-term. Then we have the other one, which is the non-current liability. Non-current, or sometimes we refer to it as what? As long-term. So with the non-current liability or long-term liability, you go for the loan or the facility and they tell you that, oh, you have 10 years to pay this. It exceeds what? The next financial year. Do we get it? Do we understand? Do you have any question? Okay, I guess there are no questions. Right. So now let's pick each of them. Let's pick the current asset. So current asset. And let's just pick some few things. Now we have like closing inventory. So the closing inventory from our P&L here, this closing inventory, they are our assets. Okay, they form part of our assets. The things that we own as a business. Assets has to do with the things we own as a business, right? And the things we own, we expect to derive some benefit from those things, right? So we have our inventory. Now it is current because the idea is that by the end of 2026 or by the end of the next financial year, we should be able to do what? To derive the benefit that comes with this inventory, meaning we have to sell and get the sales and its related what? Profit. 2, we have what we call the receivables. Some people refer to it as what? As debtors. So those who are owing us. The idea is that by the end of the next financial year, we should receive our money. We should take our money from whoever is owing us, right? We also have cash and bank balance. So this has to do with the cash you have with you in the office or the amounts you have in your bank account. The idea is that it's not going to be the same. It's going to change, right? You would utilize these funds. By the end of next year, you should utilize these funds to make more gains, right? So these are the few things under current assets. There are other things like prepayment. So prepayment is that where you have an expense and you have overpaid. Prepayment or advance payment. So example, rent. Realize that Ghana, we pay about 2 years, 3 years. Some even pay like 10 years in advance. Now, what it means is that the landlord or whoever has received the money in excess is now owing you, right? So it forms part of what? Your asset. If you are paying 2 years, if you've paid your rent for 2 years, the first year is what you have utilized, right? So the first year will be recognized as an expense in our profit or loss statement. And the next year, that's 2026, by the end of 2026, you would have consumed the benefit. So it will form part of your current. Then we move to what? Non-current. The one that we said the benefits associated with that will exceed the next financial year. So we are looking at your PPE, your property, plant, and equipment. So if you have a building, if you have a car, if you have a laptop, if you have a table, furniture, you expect to use those assets more than one financial year. In fact, building can last up to 50 years, right? So you capture them under your non-current liabilities. So you have that of intangible assets also. So these your property, plants, and equipment are your tangible assets. But you may have that of what? Your intangible assets, like your goodwill and other softwares and other things, right? Intangible assets. So basically, this will be the things under your current and non-current. If this was financial reporting, we would have had other things like IFRS 5, non-current assets held for sale. Under current asset, you may have probably investment property under what? Non-current liability. But this CIT, financial accounting, accounting and finance. So we will not go deep into financial reporting matters. Now, when it comes to your current or your short-term liabilities, we are looking at overdraft. So the bank might give you an overdraft, and the expectation is that by the end of the next financial period, you should be able to pay your overdraft. The way you are owing someone is owing you. That's the same way you might also be owing someone. So that becomes your your payables. Some other people call it creditors. So if you buy goods from your suppliers and you don't pay, then you also have some accruals, which is in connection with prepayment. So accruals or what we call owings. So if you have an expense, you've incurred an expense, but you haven't paid those expenses, it forms part of your current liability. If you are owing your employees as at the end of the period, the expectation is that by the close of the next financial reporting year end, right, you should pay them. It doesn't mean that hold on now to the end of the next financial year. That is not what it means. It means that as it stands now, as at the time we are preparing the balance sheet, we haven't paid the person, and our expectation is that by the time we prepare the balance sheet again at the next year end, right, that liability would have been sorted out. Then we move to our non-current liabilities. So our non-current liabilities, we are looking at long-term bank loans. So bank loan, I think some other people refer to it as debenture. Most likely the examiner will give you clue. The examiner will tell you either it's a bank loan or a long-term bank loan. The examiner will give you more clues as to what should go under non-current liability or long-term liability. Once again, if this is IFRS, this financial reporting class, then we may have other things that would go under the liability section, where we have to look at even issues of government grants, deferred income, making some provisions, and a whole lot financial instrument related stuff, leases and all those things, right? But once again, this accounting and finance, so our balance sheet will not be made up of complex things or complex items. Now, so basically, this is our liabilities. Then we may come up with our capital. So this is a sole trader. Our capital will be our initial capital. So what the person started business with. Then we may look at additions. Right. If the person decided to increase the capital in the course of the period, then we may also look at drawings. So the examiner will tell you that, oh, the proprietor or the owner of the business decided to withdraw 5,000 from the business account. That 5,000 that has been withdrawn is not an expense. It is seen as drawings or withdrawal of the capital the person brought. Right. So it shouldn't be treated as an expense. It should be treated as what? Drawing. So it is deducted from this. If we have initial capital plus additional, then we deduct what? Our drawings. Then we add the profit. So when we say profit, we are talking about our net profit. We add the profit to the capital. The idea is that whatever capital we are getting, the person is not going to spend it's not going to spend the profit. The person will now plow back the profit into the business. So that will increase his or her capital in the business, unless we are being told that he has made some withdrawals or he has paid some dividend to him or herself. Right? If not, we add back what? The profit. Any question? Any question? Any question? Any question? All right. If there are no questions, we will just present it nicely. Let's just present it nicely and neatly. So, balance sheet, assets. So balance sheet is also known as what? Statement of what? Financial position. It is always asset a particular period. So asset 26th October 2025. So whatever we are going to show here is assets now. There is a possibility that immediately after preparing the balance sheet, or let's say the following day, figures might change. But as it stands now, these are going to be our assets, these are going to be our liability, and this is going to be our capital. So let's start with our assets. We are following the accounting equation. We said asset is equal to what? Capital plus liability. So assets. Mostly we like to start with our non-current assets. So non-current assets, we have our property. So what we can also do here is that instead of adding everything as property, plants, and equipment, we can do furniture. We can just show them one by one. We can do computer. We can do what again? Equipment. We can do building, or let me say land and building. Land and building. Okay. Now let's do our costs, our accumulated depreciation, and our net book value. So the cost of the furniture, the cost of the computer, the cost of the equipment, and the cost of what? Land and building. Then accumulated depreciation. So all the depreciation we have charged or computed on this particular asset, right, will be deducted. Then our cost less accumulated depreciation gives us our net book what? Our net book value. So our net book value. So we have our total here. We have total here. We will close this one because we wouldn't use it again. We will rather be using our net book value figures. Then we are done. So all these things is what we are referring to as what? Property, plants, and equipment. Mind you, these are tangible ones. You may have that of the intangible, like the software and the goodwill and all those stuff. Also, be guided that anytime they give you land and building, land is not depreciated. So make sure you only depreciate the building component. Example, the examiner will give you land and building and tell you that, oh, land and building, the cost of land and building is 150,000. So 150,000. Then the examiner will give you a side note that, oh, the land component is, let's say, 50,000. So it means you have to deduct the 50,000 from 150. Then whatever you get, that is going to be 100,000. You now depreciate the 100,000, right? Sometimes the examiner will give you the value of the land, or the examiner will give you the value of the building. So instead of telling you that the land is 50,000, the examiner tells you that the value of the building is 100,000. So when you deduct, you still arrive at your 50,000. Then you depreciate just the building component. Okay, so we now move to our current assets. So our current assets, we mentioned inventory. We mentioned receivables, also known as our debtors. We mentioned our bank balance and cash. Then I think there was some few prepayments. Okay, so we can just add them. Let's just add everything together. Okay, so this gives us what we call the total asset. So your total asset is made up of what? Your non-current asset plus what? Your current asset. That gives you total assets. Then we move to our capital plus liability. So capital. We said our capital is made up of what? Stated capital or initial capital. So let's say stated capital. Let's say any additions. A minute. Additions. Then we look at let's say profit. We said that all our profit is going to be plowed back. So profit for the year, we add it. Then we deduct what? Any drawings that has been made. So we are going to deduct the drawings. Then that gives us our total capital. Then when it comes to our liabilities, we can pick it up from, let's say, long-term or current, anyone. So let's say current liabilities or short-term. So we have our payables, the people we are owing. Then let's say we have overdrafts, bank overdrafts. Okay. So current. Then we can look at our long-term or non-current liabilities. So let's just say bank loan. Okay. So when we add, we can get so let's add all our liabilities. So both short term and long term. So that gives us our total liabilities, right? Then we add our total liabilities plus our total capital, and that gives us total liabilities plus capital. So this figure here should be equal to this figure here. That is why the accounting equation says that assets should be equal to what? Your total liabilities and what? Your total capital. Any question? Any question? So you realize that even though people have a lot of problems or challenge preparing the balance sheet and the profit or loss statement, it is actually not difficult. Or it is difficult.
It's quite confusing.
Come again.
It's quite confusing.
It's what?
It's quite confusing.
It's quite confusing. Oh, okay. Oh, what makes it confusing?
I think for me, I'm new on the accounting field, so I'm just familiarizing myself with the current asset, non-current assets, how to identify that this is current liability, non-current liability, and all that. I just have to, learn more on that so that maybe next week when we come, I can ask further questions.
Oh, okay. So let me just go over again. So asset has to do with the things we own. That's asset, what we own, right? Then liability has to do with what we owe. A car, yeah. Then as for capital, there we know capital, what we use for our business. We used to do our business. Now, what we own as assets, we expect to derive some benefit from what we own, which is the assets. We expect to derive some benefits from it. Now we are saying that some of them, in terms of the assets, the benefits that we can get, we expect to consume those benefits. Let me say all the benefits within the next financial year. So the inventory that we have, the anticipation is that by the end of next year, which is 2026, we would have sold it, made some profit, made some gains from it. If it has to do with receivables,
So
we don't expect them to owe us for a very long time, right? So the expectation is that by the close of next year, 2026, but if you look at the non-current, so let me ask you, if you buy a computer or a furniture, do you anticipate that you should consume all the benefits that comes with the furniture or computer by the end of the next financial year?
no,
Come again.
no.
You expect to enjoy more, right? More than one
Yes.
financial year. So those ones become what our non-current. It exceeds the next financial year or one financial year. So those becomes our non-current. So same thing happens to liability. If we are owing someone and the expectation is that by the close or by the end of the next financial year, we should pay back those liabilities, then those are going to be short term. So payables has to do with you've bought from someone you've not paid, Udiobika or supplier bika, right? Overdraft is where the bank allows you to withdraw more than what you have in your account. You have 5,000 cedis in your account, but the bank allows you to withdraw like 7,000. So you are now owing them 2,000. Mostly, if you have such an arrangement or you're a good customer with the bank, they give you such an arrangement, and you mostly use your bank account frequently. They know that it's just a matter of a day or two. You come and deposit money, and they will take their 2,000 from it. You get it. So they give you that. It's more or less like a loan, like a facility sort of, but it is not like loan itself. Mostly loan, we are looking at 5 years, 10 years. You get it. That repayment schedule plan and all those things. But the facility overdraft is more flexible. So basically, that's the whole thing. That's the whole thing.
Okay, sir. So, what if the expectation of that particular asset that's supposed to be current goes beyond the financial year? How are you going to deal with the account?
Come again. When the current assets, we are looking at current assets.
So we
It
are looking
goes
at
beyond
it goes
one
beyond.
financial year.
Yes. Well, what are you going to do about the account?
And it's still going to be the same. So we
So
said
are
the
you going
balance
to
sheet.
roll over?
Come again.
Are you going to roll over the next financial year?
Yes, you roll it over to the next financial year. So we said that balance sheet is assets a particular day and time. So assets 2024 October 2025, 24th October 2025. Our expectation is that by next year they should happen. If it doesn't happen, we don't get the benefit or consume the benefit that comes with it. Assets 26th October 2026. What is our expectation to 2027? Should we recoup all the benefits? Yes. If yes, then it should be current. Unless some of the things, if you look at the way the things are going, like receivables, if going forward, realize that Charlie, the person is owing you, but the person is not going to pay, then you write it off as bad debt. Instead of having it in your receivables, as part of your balance sheet, you write it as bad debt and you reduce your receivable amount by that amount you have recognized as bad debt. So receivables, it's possible you may have like 5 or 10 people owing you. Then all of a sudden you receive a news that one of the guys that are owing you is dead. I know the moment you hear that, you cannot recoup your money, right? So instead of having it in your balance sheet as receivables, you write it as bad debt. Sometimes the person might not necessarily die. Example, if you sell goods to your mother and you are going to take the money, she will now give you a story of your birth that I carried you in my womb for 9 months. The moment you hear that story, you know that the money will not come. So you just go and you recognize it as bad debt. Jif, I hope you are not offended.
No, I'm not.
Okay. All right. So you just recognize it as what? As bad debt. Then you reduce your receivable amount. Any other question? Any other question? Any other question? Okay, George, do you have any question?
Not now.
Okay. So if there are no questions, we would try solving this question. So I have this year, I've done it nicely because I know my handwriting. Sometimes you guys will complain. So I've done it nicely here. You could see your sales, let's return inwards. So return inwards, you sell goods to your customer and the customer returns it. Then you look at your cost of sales, you enter everything. Then you look at other income, discount, receive investment income, rental, and all this stuff. Then we'll have operating what expenses. Then that gives us our net profit. Then we have similar issue here. This is our balance sheet. So balance sheet, our non-current assets, our cost accumulated depreciation net book value. Then we have our current assets. So overpayment, as I said, prepayment, overpayment, payment made in advance, prepaid is the same thing. When you pay in excess, right? Rent is, let's say, 1,000 cedis a year, and you pay 2,000. It means you've paid 1 year in advance. So that's an asset to you. This time around, your landlord or your landlady is owing you. So you add it as part of your assets. And then when it comes to your liabilities, you have creditors, which is also known as what? Your payables, your suppliers that have given you goods on credit. Then you have your owings, accruals, or outstanding. So one thing with like different names. So if the examiner tells you that, oh, there was salary outstanding, or you were owing salaries as at the year end, they form part of what? Your current liabilities. Then any short-term loans that the examiner will tell you. Now, if you look at the totals here, it was done differently. it was done differently. So we did a total asset minus current liability. That is what gave us our net asset. So your net asset should be equal to what? Your capital plus what? Long-term liability, which we refer to as what? Capital employed. You need this arrangement. You can just forgo this for now and probably keep what I said earlier. So total assets is equal to what? Total liabilities and what? Capital. But knowing this style is also helpful, especially when you are looking at ratios. Some of the ratios, the examiner will make reference to capital employed. Then if you've never seen it before, you become confused, right? But if you've seen capital employed, you know that capital employed has to do with what? Your capital, your total capital plus your long-term liability. Or your total capital employed is also the same as what? Your net assets. Because it should be the same. So, all right. Okay. So there is a question here. There is a question here that I would like us to solve. So the following is the trial balance of Kama Enterprise, a dealer in Oracle software, as at 31st December 2010. So this is the capital, receivables and payables. So receivables and payables. We have inventory. So this is our opening inventory. Then we have the motor vehicle. So motor vehicle, this is the cost. This is what? The accumulated depreciation. Office equipment, this is the cost. This is accumulated depreciation. Then we have administrative expense, purchases, our sales, employee benefits. We are looking at salaries, sort of. Let's say salaries. If it was financial reporting, then it will have a different meaning. But for now, salaries. Then selling expenses. Then plant. So the cost of the plant, it's what? Accumulated depreciation. Then we have discount. We have 1, 2. So we are looking at discount allowed and discount received. Then we have accruals. Remember accruals. Remember accruals. Accruals. Then we have investment income. So we are seeing some of our other income. No, sorry, these are investment income. Then we have returns. We have 1 and 2. So we are looking at return inwards and what? Return outwards. So that is how the examiner will be playing tricks with you. So this return inwards, and this is what? Return outwards. One is being returned by a customer to you, and the other is being returned from you to your suppliers. Then you have your cash and cash equivalent. Then you have allowances for what? Doubtful debt. Then you have bad debt itself. So someone is owing you, probably the person is dead or the person has gone bankrupt. Then anytime they give you financial statements, there is this we call the additional information. So they are giving you additional information, right? So the inventory as at 31st December 2010. So this is your closing inventory. Allowance for doubtful debt is to be increased to 19,080 as at 31st December. So we have allowance for doubtful debt as what? 14,000 here. And the examiner is now saying that, listen, we want you to increase your allowance to 19,000. An amount of 6,000 in respect of rent and rate is included in administrative expense. This amount relates to what? 2011. So if you look at your trial balance here, administrative expense 2. Okay, so 26,000. The examiner is saying that 6,000 relates to what? Rent and rate, which is what? 2011. Now you are preparing the financial statement for the year 2010. So it means we have what? We have some prepayment or payment made in advance. Are we getting it? Are we catching the clues now? Then all items of property, plant, and equipment are depreciated at a rate of what? 10% per annum on straight line. An amount of 10,000 incurred in the repair of plant had been debited to the plant account. So it means that there is a plant here, which is 125,000. What the examiner is saying is that 10,000 was used to repair this plant, and repair and maintenance an expense. It's part of our operating expense, but rather what they did was to add it to the cost of the plant, which shouldn't be so. So you have to what? Make the necessary revision. It means we have to revise this amount and reduce what the 10,000 from it. Then we move on to the next one. Personal withdrawal of cash amounting to 25,000 was made by Mr. Kama, the proprietor. This has not been what? Recorded in the financial statement. You realize, see something. So look at the trial balance. You see the debit side and the credit side. It has balanced, but they are telling us that there was an omission of what? Of a transaction. This transaction was not recorded. So this takes us back to our previous lecture that there are some errors that might occur, and those errors might not affect the trial balance. The error will be in there, but the trial balance will still balance. Right? And we have error of what? Omission. So this is one of them. So this is an error of what? Omission. Any question? Any question? Any question? Oh, you guys don't have any question for me? Yeah.
So the additional information,
Mm-hmm.
is it a question that we are supposed to solve with the trial balance, the trial balance that's given?
Yes, it's part of it. So what happens is that there are some of the things that might not, they wouldn't have included it in the trial balance. I don't know if you get it. There are some things that were not included in the trial balance. Example, you assuming you're an accountant, right? And I invite you over, I want you to prepare my financial statement. Then you say, oh, give me this, give me this, give me your trial balance. Then I give you the trial balance. Then you would like to have some conversations with me. Oh, okay, are you owing someone? You get it? Is someone owing you? What were the balances of your inventory? What were your inventory balances as at the year end? Some of this information will not be shown in the trial balance. So it's like ordinarily they should have been part of the trial balance, but they were not part of it. And it came up in the course of you having a discussion or a meeting with the proprietor. You get it?
Yes, sir.
So most likely, most of them would have not been passed or added in the trial balance. Some of them too would have been added to one of the items in the trial balance. But whatever be the case, because we are looking at applying our double entry principles, it means all the additional information would have two sides, will be recorded twice. Because of what our double entry concept, principle or concept that we are complying or following as what? As accountants. The trial balance, figures in the trial balance may just have one, but that of the additional information will have two legs. Example, the closing inventory. You know, the closing inventory is going to be recorded in our balance sheet, right? That same closing inventory, we are going to deduct it from what? Our cost of sales. So the first leg will be in our P&L, part of what? Our cost of sales. Then the second leg will be where? Will be here. So most likely all your additional information, in fact, not most likely, all your additional information will have that two sides. It will follow our double entry principle. So let me just do this. Let me try and just do this. Let me do this. Let me duplicate this. I don't want to really waste time. So let me just do this. Let me just do this. So for our, or I should start all over. I don't really know what to do. What I wanted us to do is to just be picking the figures. So we have sales of what? 490, and we have purchases of 2,43700. So I wanted us to do this. So our sales is going to be 490. You get it. Then our purchases. Then I'll write the purchases figure. Do you think it's the best, or I should just erase and start the whole thing? Or I should also give it to you guys as an assignment.
Hey.
So let's start over.
let's solve it then.
Yes.
Okay. All right. Let me do this. Okay, so let me do this. Okay. So let me do this so that I can be doing the thing in Excel. I think it's going to be fast. So we are going to start with what? Our profit or loss statement. So once again, the profit or loss statement is also referred to as what? Income statement. And our balance sheet is also referred to as what? Statement of what? Financial position. So let's start. So let's say Mr. Farmer, income statement for the year ended 31st December 2010. Okay. Let's do our CD sign. Now we have our sales. Our sales is 490. So 490. Then we were told that our customers, one of our customers decided to return the product. So return it. We have 12,000. Let's just do this. And let's do this so that you can have it in the middle. Okay, so that gives us, also do this. So we have this minus this giving us our, let's say, net income or net revenue. Then we move to our cost of sales. So we said we first would like to sell the inventory we have at the beginning. So opening inventory, which was given to us in the question. It was given to us in the question as what? 99. 93. Then we would purchase more after selling what we have at start. That is 243, 243, 750. So we add them together. Then when we brought to the product, we realized that some of them didn't meet the quality standards we were expecting. So we had to return some of them. So let me just do minus. We have a returns of what? 17,500. So 17,500. So plus returns. Okay. Now, did we incur any expense in bringing the item to our office? Did we? I guess we did not incur. All right. So that's fine. So we can look at our closing inventory. What's our closing inventory? It was given to us in additional information, so that would be 1, 2. So 129 100. No, 500. Okay. So that gives us so let's just move this way so that we can have a neat computation. And let me add this to it. Okay, so this is our cost of sales. Mind you, this is also an expense. Cost of sales is an expense. So let's just put the whole thing in brackets so that it's significant. signify the fact that it's an expense. Um, okay. So we deduct from it, and this gives us our gross profit. Let's just push this a little bit. So this is our cost of sales, our gross profit, sorry. Gross profit. Any question? Any question?
Shadrach,
Yeah.
please, how did you get the 195? I was not seeing
Come again.
the 195.
Uh-huh.
How did you get it?
Oh, we pick this one less this 129, the closing inventory.
This less this. So why is it negative?
Because we are coming to deduct from our revenue. The cost of sale itself is an expense. Cost of sales itself is an expense. So the whole thing, give me a minute, let me just finish up and give you the explanation. Now, let me see if I can. Okay. So this is what happens. We have made sales of 490, sorry, 490. And we had to return, sorry, our customers returned 12,000. So it means we didn't make the sale. So we have to deduct it from the 490 to arrive at what? 4,700 and what? 478,000. Now, this is cost of sale has to do with the expenses we incurred to generate this revenue, to make these sales. Now, this 479 includes the sale of the goods we had at the beginning of the period, the opening inventory. So after selling what we had in our shop at the beginning of the period, we had to purchase more because we are still in business. So we purchased goods worth 243,000. So the goods we purchased plus what we sold or what we had at the beginning gives us what? 342. Then we were told that the goods that we purchased, we returned some, which is worth 11,000. So it means we have to deduct this from the purchases. And that gave us a total amount of what? 325,000. Now, this 325,000, we are told that at the end of the year, we had goods worth 129,000. So we deduct this 129,000 to come up with the cost of the goods that we have sold to generate this revenue. Please, you get it? So that's the cost of sale. So now we want to determine the gross profit. So we want to deduct the cost of sale from our revenue. That's why we have made it negative.
Okay. Thank
You get it now.
Yes, I get it now.
Okay. So that's it. Okay. So that's our gross profit. Now we have to proceed. Let's proceed.
Hello, sir.
Yeah.
So that means some of the accounts that has been listed are supposed to be negative balance.
The account that has been listed has to be negative.
I mean, some accounts are, let's say, by its nature, negative balance.
Should I say by its nature? I wouldn't say by its nature. I would rather say by the role or the function that they are playing.
Okay.
So first of all, cost of sales is an expense. So something like returns, we have incurred an expense, and we said that we don't want it again. Take your product and give us our money. So it means that particular expense that was incurred earlier has to be reversed. You get it? So reversing it is what is making it negative. Cost of sales, we are just accumulating all expenses here. So if an expense has been incurred, it's being added. The purchase was added, right? If we are reversing the purchases, we have to do negative. So it is more of the role that they are playing rather than the nature. Mind you, cost of sales is an expense. People don't know this, and that is what creates confusion sometimes. Cost of sales is an expense. So now let's move on to other income. So we have other income. So I think we were given some few things. Investment income, and I think discounts. So let me also say this. Anytime you're giving the trial balance, right? The trial balance is made up of what? Your debit and your credit balances. Now, the figures on your right, on the credit side, they are either revenues, liabilities, or what? Capital. Then on the debit side, it's either an asset or it's what? An expense. So have this at the back of your mind, just in case you are confused on how to treat a particular item, right? Just have this. It will give you a proper guide. So most of the items, this is it. On the debit side, it's either an asset or an expense. And also on the credit side, revenue, liabilities, or capital. So we are looking at capital on the credit side, receivable and payables. We said on the credit side is for what? Liability. So indirectly, this one tells us is what are payable. You get it. So that is how you'll be able to identify some of the figures. We have discount. We have discount here. We have discount here. So this one is discount received, and we have investment income. We have accrual. We said accrual is what? Under liabilities. So discount, and we have investment income. Okay. Investment income. So our investment income, we have 27,500. Then we have discount of 12,500. So that gives us a total of what? 40,000. So 40,000. So you do 40,000 plus. I should have done this as well. 40,000 plus. Oh. So plus our gross profits. Okay. And then we now deduct our operating expenses from it. So let's do operating expenses. Operating expense. So operating expenses. So let's look at our expenses. Let's list them. So we'll be looking at what our debit side. So we have administrative expense, 26,000. So admin expense, 26. So let's do 26. I remember the additional information said something. So That is why we are doing it this way. Let's do this.
Sorry,
Then
your line was breaking a bit. So.
come again.
Sorry, your line was breaking a bit.
Oh, okay. Sorry, but is it okay now?
You said your yes. You were saying something about the administrative expense.
The admin expense. I remember the additional information said something about the admin expense. So it means an adjustment will be made to the figure. That is why I brought the 26,000 here instead of recognizing it here.
Oh,
Do you
okay.
get it? Uh-huh.
Yes, please.
So we have employee benefits. That is 33,000. We have selling expense, which is 20,000. Then we have discount. So discounts allowed. That is 7,500. Okay. We have bad debts. Oh, sorry. So bad debts. As well, 17,500. In fact, we have provisions. Because I remember provisions for doubtful debt or allowance for doubtful debt. I remember the additional information also made reference to something. So let's do 14,000. Think that should be all. Is there any other thing that has been left out? Okay, we've not dealt with what? Depreciation. So depreciation itself. So depreciation. Let me see if I can push it. Okay. So that's good. So depreciation, we have to do that of what? Our motor vehicle. I remember the additional information, we said 10% on cost. So that would be 72,000. The cost of motor vehicle in our trial balance is 72,500. Then we have that of what? Office equipment. So that would also be the same 10% times the cost, which is 90,000. Then we have what? Plant. So plant is also going to be what? 10% times what is the cost of the plant? 125,000. I think the additional information also said something about the plant. So let's make it open. Let's just make it open. Okay. We may have to do some few things. I think that should be all for our operating expense. So now let's go to the additional information. Let's see what the additional information is now saying. So the additional information we have dealt with the first one, which is the closing inventory. Then we have the allowance for doubtful debt. Now, the allowance for doubtful debt, we had 14,000. Okay. So see the allowance for doubtful debt as a provision you have made that, oh, let me put this money aside in case someone don't pay me. Instead of the amount reducing my capital, I just bring in the money so that my capital can still be on the same level. Right. So you have decided to set aside like 14,000, and you are being told to increase the amount from 14,000 to what? To 19,080. So the increment or the difference is going to be an expense to you. So let me just do this. Please, do we get it? Correct it. It's because of the comma I brought in. Let me just do negative so that we have a positive figure. Please, do we get it?
No, please.
Come again.
No, please. So, okay, the
It's
provision
okay.
for no. I'm saying no, please.
Okay.
The allowance for doubtful debt, is it an expense? Hello?
Okay. So it's not an expense. It's like you setting aside money. So you are putting money aside. So what you have done is you have 14,000. In case you sell goods to someone, the person doesn't pay. Instead of it reducing your capital, you just go and pick the money and come and add it up. You get it? So in the trial balance, we were told we have 14,000. So what it means is that you have set aside 14,000 already. This time around, the examiner says that increase the money from 14,000 to 19,000. So the difference will become an expense, an additional money you have to set aside. Do you get it?
Mm-mm.
Okay. So you sell goods, right? And sometimes you've observed that people buy goods from you on credit. Okay. And sometimes when they buy, they don't pay. Maybe it's because they are family friends, or in fact, they are family members. So when you ask them and they don't pay, you ask, no, it becomes family fight. So what you've done, and anytime they don't pay, it reduces your capital. The money that you're using to do business goes down. Please, are you following the conversation?
Yes, please.
So in your own wisdom, what you've decided to do is to set some money be aside, just in case such situation happens. Your capital will not go down. It's just a matter of going to pick that money you set aside and adding it to whatever you have to increase it's not even about increasing, so that you can still be on the same level in terms of your capital. Have you gotten it up to this level?
I think so.
Oh,
No. No,
okay.
please.
Okay. Now
No, you go
let me
ahead. Maybe
no,
later
no,
I'll get it. No,
no,
you go
that
ahead.
is a crucial place. If you're able to get it at that point, you would understand. So you say amount for idea on credit from you, right? And now omotono nti akabia usika ekofom. Usika na the age man ekofom. Nti dia why ni say who usika bia odi ato nchen. In case say obi beto ade na we ntua na usika sem na ekofom a. No say wakofa asase kan na the kan de owo no ho na de akofa niema aba. What I say?
But the money you're setting aside, isn't it also from your profit?
It can be from your profit, previous profit, or all those things. But as it's in the trial balance, it means it exists at the order. And as if you have provisions in the previous years, or
So,
maybe
so
your
it
husband
doesn't
gave you.
pertain to this current uh, balance. Is that why it is not an expense?
Uh-huh.
Because it doesn't pertain to this current one.
So
Or
the 14,000 is telling you that more or less it has been there. So what I say. Nti who sika no da hɔ deda. Nti na wohwɛ position no kra in the trial balance it's showing as an income. More or less, it's on the credit side. So what I
Okay.
said. So you have money somewhere. Now, I feel query, no. When we say 14,000 now, or they are two chain. And soon, because what Tonyama on credit be this year, so it is possible that your bad debt might be more until you increasing from 14,000 to 19,000. That's what I said.
Okay. Yeah.
Until the increment, will be an additional expense for you this year.
Okay.
Please, are you following?
Yeah, I think I get it.
So the increment, will be an additional expense. But assuming we were reducing it, that would have been an additional income.
Okay.
So you have 14,000 with the bank, and then you see at the main tone goods on credit. I don't even sell on credit. It's cash and carry. So that 14,000, I can even reduce it by, let's say, 5,000. So now say you go and pick that 5,000, come and use to add to whatever you're selling. You come and put it in your business.
Okay.
But this time around, you sold on credit to a lot of people. So you are feeling that, that 14,000 might not be enough. So you want to go and add up to the 14,000 to shoot it up from 14 to 19. So we are saying that whatever you are adding it up, which is the difference, will be an expense that you have to incur.
Okay, I get it.
Unless maybe you get money on the floor and you're going to add it to your 14,000. But if you are not getting money on the floor and you are going to use a portion of the business income, then it should be treated as an expense.
Okay.
Okay. Any other question? Okay. So let's move on. So the next one, an amount of 6,000 in respect of rent and rate is included in what? The admin. And this amount relates to what? 2011 financial year. So what it means is that this 26,000 has to go down by 6,000. Now, mind you, this is your profit or loss for a period. So the period is 1st January to 31st December. Any transaction that relates to another period would have to be what? Be removed, because we want to just focus on all transactions that transpired under this period. So if you joined the session where we talked about the accounting concept, we talked about periodicity and we talked about the matching concept. And we said matching concept, for the purpose of determining our profit, we are going to match all revenue that was generated in a particular year against all expenses that were incurred in that same period. Now, this transaction is an expense that relates to 2011, not 2010. So it means we have to do what? We have to take it off for the purposes of what? Determining profit. So we have 26, 1, 2, 3, minus 6,000, giving us 20,000, sorry. 20,000. Any question? Any question? So this 6,000, it means it's for rent. So it means our landlord or our landlady is owing us 6,000. So it means it will form part of what? Our current asset. As what? As prepayment. As prepayment. We have made payment in advance. Okay. Let's move on to the next one. So the next one, we're told that all plant property, plant, and equipment are depreciated 10%. So you can just go ahead and do this. So let me just take the comma from it. Then we can get our depreciation. Now the last one, so we have to do similar thing, but there was an additional information. The examiner said that an amount of 10,000 incurred in the repair of plant had been debited to the plant account. So it means we have to repairs of what? 10,000. Now that 10,000, we have added it to the cost here. So the cost shouldn't be 125, but rather it should be 125 minus 10,000, meaning 115, right? So we'll do 10,000 before we apply the depreciation rate on it. So giving us the book comma. So this is how it should be. The 10,000 should be treated as an expense, not as what part of what the cost of the asset. So this minus this. Yeah. Then the last one, personal withdrawal of cash amounting to 25,000 was made. This is a withdrawal of the capital, so that will not form part of our expenses. When we're looking at the accounting concept, we made mention of business entity, where we said the owners or the owner of the business is separate from what the business itself. The business generates its own revenue and incurs its own expenses. So when we are preparing the financial statement, the expenses that has been incurred by the owner should not be included in the financial statement of the business. So if you withdraw money, whatever you want to use the money for is none of our business. We would assume you have taken a portion of what your capital. So what it means is that even if the examiner had told us that, oh, he withdrew money for his personal use or personal withdrawal of cash amounting to 25,000 was made by Mr. Kama, and he used that money to buy a car, that car will not be included in the company's property, plant, and equipment. That's his personal transaction, and it shouldn't be what it shouldn't form part of our expenses as a business. So let's just add them up. Okay. 140,000. Let me just do some so that we can get it to negative. It's an expense. Then let's do this. So we now have a net profit. Profit. So this is our net profit. 1.8. Let me even do this. Yeah. So our net profit is 181,420. Any question? Any question? Any question? Oh, do you have any question for me? Oh, okay.
No question from me.
No question.
Yes.
Okay. Um, Governor, any question? Any question?
No, for now.
Okay, George, any question?
No, sir.
Okay. So if I think there is a slight omission, I'm just seeing it. The revenue is 490,500. So there's an omission of 500. Okay. So I think it will push our net profit to 181,920. Okay. So if there are no questions, we will end here. I will share the slides with you guys. Then you guys should go ahead and prepare the balance sheet. And also, there is another question. Let me see if I have the solution. Yeah, I don't have the solution. So you can also prepare. I think there's another question. Yeah, so there's another question. So solve the balance sheet and also solve this question as well. All right. Thank you for your time. Enjoy the rest of your weekend, and we'll meet, God willing, next week. Same time I'm saying. Bye.
Right. Thank
Okay. Bye. Thank you.